Hello number curious friends, welcome back to the channel where we talk numbers. Inventory comes and goes in weeks, but some assets stick around for years. Today we'll get back to technical stuff and learn how to account for those long-lived heroes, our fixed assets. We already talked about our hard-working truck, which we used to deliver apples from the farmer to us and from us to a customer. It did a great job for us over months. But what is a fixed asset in general? A fixed asset is anything the business will use for more than 1 year to generate income and not just resell. It is also often called non-current or long-term asset. And in broad terms, it can be split into two big categories: tangible and intangible assets. Tangible assets are the assets which have a physical form, in simple term, which you can see and touch. Intangible assets are the assets without a physical form. Here you go with a few examples. Tangible assets could include a truck, a store building, office building, computers, printers, machinery, the machinery for example to wash and pack our apples. Simple example of intangible assets could include software licenses, for example accounting software, trademarks and brands, patents. So, you are buying something. How do you decide whether to put it on the balance sheet or to expense it directly as a cost in the P&L? By the way, putting things on the balance sheet, if said in a scientific language, would be called to capitalize. Here are some basic recognition rules which are broadly similar in both GAAP and IFRS. You capitalize an item when: first, future economic benefit is probable, it will help you earn money in the future. And second, cost can be measured reliably. Everything else, just expense it immediately. Okay, let's agree we capitalized an item we want to buy. How do we measure its value to put on the balance sheet? General rule: we record the asset at cost. And this cost will be the purchase price minus discounts plus cost to bring it into a ready-for-use state. For instance, delivery, installation or legal fees. But here you ignore training or startup losses. These are temporary and don't add value. That's why we expense those. Let's have a look at an example. We buy a truck and receive an invoice of $15,000 for it. In addition, we incur registration and delivery costs of $500. We add them and capitalize $15,500 on the balance sheet as fixed assets, a truck. What happens next? As the tangible assets wear out, we depreciate them to reflect the cost of it for our business. The depreciation spreads the cost of the truck over its useful life. Let's assume the useful life of our truck is 10 years, with no residual value left after those 10 years. Depreciation per year would be 15,500 divided by 10 equals 1,550. How does it look in accounting? Journal entry each year would be: depreciation expense, debit 1,550, accumulated depreciation, credit 1,550. Accumulated depreciation is a contra asset. It sits under the truck on the balance sheet, reducing carrying amount. Every year you will expense 1,550 and increase your accumulated depreciation by it. So, in year 2 you will have a total of 3,100 decrease in the value of the asset, which will now be 12,400. This amount is called net book value or NBV. You can record it via T accounts as well. It will look like this then. Cash, credit 15,500. Truck, debit 15,500. Depreciation for year 1, P&L 1,550. Accumulated depreciation 1,550. Depreciation year 2, P&L 1,550. Accumulated depreciation after year 2, 3,100. Books are balanced, all debits equal credits. But there is one asset which is normally not depreciated. It's land. Its value usually doesn't wear out, though the building on it does. But if the value of the land falls significantly and rapidly, you will need to impair it, write down its value directly. What about intangible assets? They can fade too. For example, intangible assets with finite life, say a 3-year software license. Here we use amortisation, as for tangible assets. For example, a 3,000 license over 3 years equals 1,000 expense of amortization per year. Same double entry idea, we just call contra account accumulated amortization. At the same time, there are some intangible assets which may have indefinite life and are not amortized. For example, goodwill and certain trademarks. We will come across goodwill in later lessons. For now, just know there is such a thing. In this case, every year, instead of amortization, they are assessed if their value still holds. This is called impairment test. And this treatment depends on different accounting principles. For example, goodwill is not amortized under IFRS, but it is amortized under German GAAP. However, even if the asset is depreciated and amortized, sometimes its market value can drop below its book value. In these cases, you need to test it. You compare carrying amount versus recoverable amount. The recoverable amount is normally the higher of two things: value in use, meaning how much benefit you can generate from it, for example, produce something on the equipment and sell it until the equipment completely breaks down, or the second one, fair value, meaning market value less cost to sell. For example, if the book value of your asset is 10,000 and it is higher than the recoverable amount of 7,000, you will need to record impairment loss of 3,000 and expense it and write your asset down to 7,000. And what happens with the costs you incurred additionally during the life of your asset? Here you have two options. For routine maintenance, you expense them. They just keep your asset running, like repainting your truck or exchanging oil in the engine. But for major upgrades that extend life or capacity, you add it to carrying amount and redepreciate over new life. For example, install a refrigeration unit in the truck for 2,000 and capitalize it, and then recalculate depreciation on the new total. Okay, let's have a quick look at IFRS versus GAAP accounting of fixed assets. Both systems follow the same logic. IFRS allows a revaluation model. You can carry asset at fair value if active market exists. US GAAP sticks to the cost model. For beginners, stick to the cost model. Cost model is the default and easier to follow. Okay, we have briefly run through the topic of fixed assets. Let's summarize it. Fixed assets mean resources used for years, not for resale. Tangible fixed assets depreciate, intangible fixed assets amortize, unless they have indefinite life. Debits raise assets. Depreciation and amortization are credits to contra accounts. Track upgrades and test for impairment to make sure that you properly reflect the value of the asset on your balance sheet. Congrats, fixed asset accounting no longer sounds like heavy machinery. In the next lesson we will discuss the disposal of fixed assets and their impact on cash flow. Stay tuned! If you enjoyed this lesson, hit like, subscribe and ring the bell so you don't miss the next lesson. See you soon!